I would like to briefly introduce our fantastic panel that we put together tonight to discuss how this most recent tax bill can have a real effect on the family office, private equity, and other sponsor communities. To my immediate left is Steve Good. He is a tax partner at Gardier, focusing on corporate and partnership tax issues, and the former managing partner of our firm. To Steve's left is Paul Howell. Paul Howell is an M&A tax partner at Grant Thornton, where he is also the regional head of M&A taxation. And finally, but certainly not least, we have Rick Latcher, a managing director of Houlihan Lokey, and among many other positions, one of the co-heads of their M&A committee. Our panelists have over 100 years of practice among them. That's one bit and I think we're going to have a good conversation tonight. Our goal is to have a conversation. I'm going to introduce a few topics for our panel, but with the hope that we can discuss this from each of their perspectives and to understand really how these tax bills may have a practical effect on everyone in this room's future. We will reserve some time at the end of the presentation for questions, so I do ask if you have any questions, please hold them to the end. So that being said, let's get into it, and we will begin relatively straightforward, and that's for each of you. What are the biggest questions that your clients are asking in light of the new tax bill?
I think the question that we get most right now is sort of what structure do you want to use? And if you pick up the newspapers, they're all going to say, well, should everybody be going to a subchapter C corporation? The rates are 21%. Short answer to that from a tax lawyer is probably not. It's a lot more complicated than it used to be. The answer used to be almost certainly not, depending on your other your structure, public companies, that sort of thing. But if you have a choice to go for a flow-through, pay one level of tax versus pay two levels of tax, I mean, it's 21%, but there's still two levels. What makes it more complicated is how much ordinary income do you have, what sort of capital gain do you have, and we'll go through that a little bit later. But the big issue we're hearing about is choice of entity, whether you want a flow-through entity or a subchapter C to take advantage of the 21% corpus rate.
You know, from a investment attorney standpoint, I guess, and from the accounting standpoint, we're getting the same question. And you know, the thought is, you know, which one is it? So we immediately come back and say, well, we can tell you what's the best thing to do, but we have a bunch of questions, and we need to do some modeling. It makes a big difference on things. You know, what's your income going to be going forward? How much income are you going to have distributed to yourselves going forward? Well, how long is it? You know, do you have an exit strategy in the recent horizon? Those are the types of things that are very important to make a decision, and you really have to take those things and then do some modeling to make it, and then once you get the model in place, the question is, what would happen if it's changed by my sell horizon changed by 5 years, or I decided not to sell? Would that change it quite a bit? So I think that the answer is personal to everyone's situation.
I would agree with that.
Is that on? Yeah, I would agree with that. On the investment banking financial side, we had not yet seen the impact on transactions. I think a lot of people are trying to figure it out in terms of how it affects people's perceptions, how it affects values, how it affects people's thought process. And I would say where we are right now, especially for transactions that have been in the marketplace, I don't think there has been an impact, because I don't think a lot of people have figured out exactly how it's going to hit them, or if it's a transaction, especially a strategic one, that's going to come first. Obviously, at some point in time, when Steve and Paul can figure out how these things should be modeled, that ultimately will have some kind of impact on valuation. I think the jury is out on that, and remains to be seen of how much of an impact.
Yeah, I think the thing to realize, when they talk about tax simplification, well, this wasn't that. It was simple for individuals from an individual tax point of view, because they took away all your deductions, right? So they made that work. But they gave you a higher standard deduction and said, go with the flow. That's what that is. But on the corporate side, it is significantly more complicated. And so when they talk about modeling, when you look at these issues, when you have choices of entities, I think to me, sort of the fundamental issue you've got to look at how much ordinary income are you producing, how much you're going to be distributing, whether it's capital gains. Because what you'll hear is that the effective tax rate for a subchapter C corporation, even if you're paying out the dividends, is basically about the same as what it would be if you earned it individually. That's true if you buy a bond, and what you do is you put it in a C corporation, it doesn't appreciate in value, and it generates interest income, and you distribute it out. Well, that income will be taxed twice at about the same rate as an individual. The difference is, what happens if that's not your scenario? You have an asset that doesn't appreciate, I mean, it doesn't produce any income, but it's a capital asset that's going to appreciate in value. Corporate rates, you're going to pay that same amount of tax, almost 40% effective rate, whereas as an individual, you pay 20%. So it's really a capital gain versus ordinary income kind of play. How much of that are you going to have? How much are you going to be distributing? So those are the kind of issues you have to think about now. But people are going to say, well, if I can accumulate it at 21% for long enough, will that make up for it? So it goes to sort of Paul's issue. What's your investment horizon? How long are you going to be getting the benefit of those lower rates? But you got to look at what your exit strategy is. So it's just it's going to be a lot more complicated math to figure out which is the best structure. But it's still 2 levels of tax. It's hard to get away from when you got 1 level on the other side.
And on top of that, we throw in, and we're not going to go into real detail on the foreign changes, but you got the foreign changes in the way that entities are being taxed, and that makes it even more complications on which way you would go versus corporations versus flow through, and it may tip the scale going the other way if you have a lot of foreign income.
And maybe one thing you guys can think about is if you are a pass-through, a sub-S or LLC, and you are thinking about selling the business in the future, here again, that time horizons, are you better off doing that sooner than later? Are you going to lose that potential ability for a buyer to amortize the entire purchase price if you could write up the assets? And you have issues like that. And so what are you thinking, or what are you seeing, or where is the tax code? I understand some of that stuff is a little uncertain as whether or not basically a 338, or an LLC step-up counts as a purchase of capital equipment.
Well, let's just take pure numbers. If you were to say, with the partnership part where partnerships and S corps should get a 20% amount that's not taxed potentially, and if that's the case, that takes your individual tax rate down from 37% down to 30%. But then you get an increase in your basis, and when the increase in basis on selling, that is equivalent to 14%. So if you take your 30% net tax rate minus the 14% benefit you get in your increase in basis, that takes your tax rate on a flow-through down to approximately 16%. So the 16% is really less than the 21%. Well, that's if you're going to sell. You add that to the fact that a buyer would get a step-up in the flow-through, and that enhances the transaction. So there's a lot of moving parts you have to look at. And so it's hard to say for one particular situation. If you were to tell me that your horizon for selling was in 3 to 5 years, I would say you want to think very seriously before you ever want to switch over to a C corp.
It's an interesting debate about the whole, what happens if you have a C corp. When you sell it, you get some sort of discount on the pricing because you don't get a step-up basis of the assets. And I've had this discussion with a lot of people, a lot of bankers, and there are people I've had that discussion tonight with said, no, we don't ever see that. My response to that is, yeah, you don't see it because you don't know. You just sold the C corporation. You don't know how much of discount you just took because you didn't sell a flow-through entity, because they didn't come in and say, what's the difference? If you say I'm only selling a C corporation stock, you're going to get a price. If you give them a choice between the assets and the stock, you might find out it's not going to be cost effective to sell the assets, but what if you've been a flow-through? The problem is you don't know the answer to that because those two things are not going to exist simultaneously. So, its issue is out there, and I've heard a lot of people say they don't think if it's a big enough deal that step up is that important to people. personally doesn't make any sense to me, because I talked to other people who are on the buy side of big companies, and they will say, I talked to one CFO who's a major Fortune 100 company, and he said, you know, they put 10 or 20 people on every deal they do to look at just exactly what their book tax issues are going to be. It affects their financial statements. They want to know what that is. So if you think it's not happening, I mean, you know, you can get lucky. You can find a guy who doesn't care, but I think a sophisticated buyer is going to look at that difference, and you're going to pay a price for that at some place along the line.
And I also think it makes a difference on whether you have a strategic or a financial buyer. Because a lot of times your financial buyers may have a flow-through type of structure, so they would want to keep that flow-through type of structure instead of buying a C Corp. So they're looking at that, and they may be more interested in what that benefit is to them during their, 3 to 7 year horizon on why they're owning those assets.
Here again, talking about that, what we have seen a lot of private equity firms and hedge funds, they will set up an offshore entity. Does that change, does the new tax law change that dynamic? Because here again, we will see a lot of structuring done with certain financial buyers that will take that into, basically, can we flow through, and then they're ultimately worried about how it hits their pocketbook.
Rick, you're not supposed to be asking the question. You're supposed to be answering the question.
I'm not a tax guy, so.
I knew you were going to do that. You said you were going to sabotage us here. No, it changes quite a bit on the international side of things, whether it be a subsidiary of the company you're buying, or whether you're trying to take something offshore. There's a lot of things that have to be looked at. There's also, as it relates to offshore acquisitions, and we hadn't started into this yet, but the whole change in the limitation on debt, there is going to be more of a push to take the debt offshore up to the limitations for thin capitalizations in the foreign jurisdictions. So all these other rules out there that come into play are going to be tweaking the way that we look at it from a domestic versus a foreign standpoint.
Let's step back for a second, because I think this has been a fantastic conversation about how much this tax bill is driving choice of entity and changing the analysis. So for those of us who are not tax professionals and who have maybe a general sense of what the bill's done, but haven't gone into the weeds, and who are under express instructions not to nerd out tonight, the 3 or 4 most significant changes in this tax bill that's really putting this analysis into flux. I think we've alluded to some of them, but it may be useful to spell out what we think is really happening that's driving this.
I think the corporate tax rate going from 35% to 21% is probably the biggest change, just the amount of dollars. I think the international changes, which we're really not getting a lot into tonight, but in terms of dollars, if you just pick up the newspaper, you see how much money is coming back into the U.S. I mean, it's billions and billions of dollars. What's going to be the impact of that on the economy? They finally got it right on that. The corporate rate was the biggest issue, because we're just not competitive globally at the rate that we were at. So it allowed people to make decisions now that are more economic and not totally tax-driven. It'll be interesting to see, and Paul can speak to this more in detail, but on the limitation on interest deductions, a lot of you guys are doing deals that are highly leveraged. The way it works right now, without going too much into it, it's limited to 30% of basically what's your EBITDA. You get to add in depreciation and amortization, or add it back in determining the limit. I think in 4 or 5 years out, that's going to go away, so the limit will get smaller. But how much of these deals are you going to be able to finance at the highly leveraged areas that you're doing now? I think that would be a big part of it. The other one that you hear a lot about is the 20% deduction for pass-through income. It's called pass-through income. It's not exactly right, because you could have a sole proprietorship and you still get it. It's a non-subchapter C income, basically. If you have a certain kind of income, you can get a deduction for 20% of that. So it reduces the rate. I don't know if that affects deal flow, but it really just affects what the after-tax rate is going to be on these investments. So those would probably be the 3 biggest factors.
Then another one that's one that makes a big difference now is the depreciation deduction, the 100% depreciation deduction. Because right now, if you can, and this is another reason why you want to buy assets versus buying stock, is if you buy assets, the whole, because it used to be for taking the 100% depreciation, bonus depreciation deduction, you have to buy new assets. Well, under the bill, it's used assets too. So if you were to buy a company, the PP&E that you were purchasing, you can take a deduction on that immediately. Well, if your deduction is large enough, you're not as concerned about your interest expense deduction in the short term. The problem comes in is that the phase out of your depreciation deduction and the change of your interest deduction from EBITDA to EBIT happens about the same time. And so when that all happens, that's whenever, I know that people would sit back now and say, well, it's not affecting me now, it's not really affecting deals as much today, but it is going to affect deals. And, and I've read some stuff saying it's going to drive down the multiples of deals, because if all of a sudden you have to get alternative financing, you have to get more equity or something, some other way that you have to finance your deal, the return that you want to get that's pulling away from your return is going to make it so it's going to drive down the value of transactions. So there's a lot of factors that are going to come in that may not affect us today. And as a matter of fact, of these transactions, I do a lot of work, inmate tax with private equity firms. Well, they're not running to me and saying, Paul, what I need to do now. I think that they're doing deals as and we're telling them what effect they have on particular deals. But it's more of a wait and see as opposed to being scared right now. So based on their knowledge, I'm not sure if it's affecting them that much today as it will as we move forward.
I would echo, if I knew anything about tax, I'd echo many of the same things. I think there was a perception, that as rates went down, values go up. And if you think about a discounted cash flow and an interest rate, the lower the interest rate, the more future cash flows are worth. When talking to some of our clients on the strategic side, they really don't view it that way, that they're really looking at what they think the business is worth. And I know that at least fundamentally today, they have not changed their views on value because of lower rates, which means in theory, on the cash side, they're going to get a better deal. We're still trying to work through a lot of the NOL issues in terms of how that affects, people that have what we call NOL companies that we would sometimes go to sell a business, or how people look at the value of that. Same thing with the value of a step-up by definition has gone down, or the value of the step-up already on an existing balance sheet. Here again, we would try to sell and get value on those. And by definition, all of those have gone down. So there's a bunch of different ideas out there, so to speak, or information that we're going to have to get our hands around. The whole thing is going to get down to, as we talked about earlier, modeling, to say, how does the math really work? But I don't think you have yet changed the perception. And then just one other issue, especially in the financial buyer side, or two other things. It's going to give large corporate buyers a little bit of advantage over financial buyers, especially with larger transactions, which tend to be highly leveraged. And second of all, I think the real test in a lot of this will be when we hit a bump in the road. At some point, we are going to hit a bump in the road. Default rates are going to go up, and you're going to see debt go into default at a much greater level than where it is today. And if you think about a highly levered company, and all of a sudden now they become a taxpayer because they can't deduct all the interest they need to, and all of a sudden now it's, you have a company that's not doing well, can't pay its debt, now can't pay its taxes. It's going to create some unique situations. If that happens enough, that actually may ultimately factor into valuations in the other direction, not inconsistent with policy.
Some of the changes really didn't get a lot of press, one of which was the limitations on your ability to use business losses in excess going to return $500,000. So, you think of a startup company or even a transaction or a lot of transaction expenses, and you generate a loss, one, you're going to be limited in how much that you can use in a given year, $500,000, which is, in the scheme of things, is not a huge amount. NOLs, you can't carry them back anymore. So if you generate that loss in a transaction, you can't carry it back to get prior year's taxes refunded. You carry it forward, you can only use it to offset 80% of your taxable income, so it has less value going forward. So the whole thing about what expenses and what losses you're going to have, you know, they sort of changed the rules of the road on that, and it didn't get a lot of attention out there. You know, there were so many things that changed, and so many of them that are just not very well drafted, so people don't know exactly how they're going to work. I think we are going to have to work some of this out, but I think some of these are going to have more impact than people think. It's just going to take a while for everybody to see where it hits them.
So all of you have discussed how these changes have begun to have a short-term effect, not necessarily only on taxable treatment of a company's income, but also on how these effects are cascaded and possibly affect the market. We've got an attractive environment to bring cash back from overseas into the States. We've got an environment where that somewhat may disfavor or may prove to, in the long term, disfavor leveraged buyers. Based on what you've seen so far and understanding that we are a few months into a very different tax regime in a lot of ways, how do you see this affecting not just an individual company's profits and losses, but the market for deals generally? Do you think this is going to create more of a seller's market as more strategics become competitive? What effects do you, based on your judgment now and understanding we have very few data points today, how do you see this affecting the market?
I think people ultimately adjust to the tax regime, and so I think there might be a short-term favorable impact here or there, but I think as a general rule, the M&A market's going to follow the economy, and I think that will be the bigger predictor of future activity. And yeah, on the margin, there may be a little more strategic activity because they have a lot more cash on their balance sheets. But on the other hand, if it does suppress a little bit of financial buyer activity because of leverage, then I think those things balance out. And so I think we're going to see a normal cycle. The other thing on the margin, which is going to affect at least the PE world, is now a 3-year hold period. And so here again, most of the PE firms, I thought it's what you had to hold it for 3 years.
Yeah, for carried interest.
Yeah, for carried interest. So the PE firms, when ultimately the GP is going to look at how much they get when they sell a company, they're going to look at that 3-year hold. So if anything, there may be a little bit of a push back with some PE transactions where you're not going to see a company flip in first 12, 18, 24 months because of they're going to do the math and say, God, if we hold on another 12 months, but we can arbitrage some tax.
Yeah, I had a client explain this to me one time very clearly when I came up with a real clever tax idea to save money, and he said, yeah, great idea. It's an extra $1 of expense I get to deduct it. So what does that save me? 35 cents. I got a 14 multiple or whatever it was, so you just cost me $14 on my valuation, so you save 35 cents in taxes. He said, don't do that again. Tax drive the deal, no, but once you have the deal, you want it to be as tax efficient as possible. I think that's really what it is. You just jumping ahead a little bit to the carried interest, the carried interest is basically profits interest. It's just an interest in the future profits of an investment. And so the complaint was that some people in the room maybe, you get taxed at capital gains rates on that, and it could be argued it's really for a service, and it should be taxed as ordinary income. So they've been trying to do that for a long time. I said, okay, we won't do that, but we'll make you hold it for 3 years, either the asset or the interest itself. And as soon as they did that, the way they said, well, this doesn't apply to carried interest held by corporations, and it just said corporations. So the clever people said, okay, we'll put it in an S corporation. That's a corporation, but it doesn't have. The whole idea was, if the carried interest could be taxed at the corporate level, then you didn't care about this 3-year hold. If people were going to put it in an S corporation, it would flow through, and so you wouldn't have that corporate level tax. And Treasury just came back out and said, we're going to buy a notice saying that a corporation does not mean an S corporation. So, if you come up with a good idea, there's a lesson there. Just keep it to yourself.
We were talking a little bit about the transactions. In the last quarter of the year, transactions slowed down a bit, and I think it was more of a lesson on both the sell side and buy side it was more kind of let's wait and see. And now that the Tax Act is out there, while I don't think that the private equity groups have gone out and just really spent a lot of time to understand things, but I think they feel safe enough that things are back the way they were. So there's a lot more transactions happening now in the first quarter than there were in the fourth quarter. And I think that with the amount of money sitting out there in private equity funds and transactions, I think that in itself in the short run could increase the multiple some. And we talk about how later on it could balance out, but I think that there's more of an excitement about the fact that the landscape hadn't changed too much to make it so they can't do their deals.
Yeah, but one interesting thing is, if you look at the buzz in the press about the tariffs, that will probably have more of an impact than the tax changes, only because M&A activity generally is a perspective of what somebody thinks about the future, and when you have more certainty, you feel more comfortable doing things, and when there's less certainty. So right now, if you're in the steel and automotive business, you may say, we may have some good times ahead, so we don't do anything today. But if you're going to be a buyer in that industry, you may say, hold off because maybe this will reverse. And if you are one of those businesses or on the wrong side of it, maybe automotive, if you're looking at a business that's possibly going to have cost increases, here again, as a buyer, you're going to take a step back and possibly relook at what you think that business ought to be worth. And a seller is going to, almost by definition, disagree with you that, oh no, those are changes not going to impact our business. So here again, it's a lot more macro. And I do agree with Steve that ultimately the large percentage of transactions are not driven by taxes. Yes, there are times where you need that to make that work. When you get a deal cut, you go structure the best possible structure. But I think the macro forces ultimately aren't going to prevail over some of the tax issues. And ultimately we just need to, we've been in a great M&A market because there's been this perception of economic stability. And I think as long as that continues, I think the M&A market will continue to be strong.
So speaking of the M&A market, under the new tax regime, what advice are you giving to buyers and to sellers that you didn't have to give at the end of last year? And what's changed? What, at the start of the process, questions should buyers be asking and sellers be asking that they weren't asking a year ago?
Well, one of the questions that sellers are asking, there's some new rules that came out as it relates to what intangible assets are being taxed at ordinary income rates. So before, you only had a few items that were excluded from being considered to be an intangible. Usually we think about intangible, we think about goodwill. And goodwill. And there we go. Yeah. And goodwill from a seller's perspective is usually looked at as being a long-term capital gain tax, capital gains rates. Well, they made a change, that definition, to include several other items. One of the big items is patents. And that's the one that's most easy to understand what it is. If you're in the technology area, you understand, especially in that area, but in other areas too. But they also talk, about processes and things which are not quite as defined. So if you're selling these patents or processes, you're going to have, and you're selling assets, you're going to have ordinary income as opposed to capital gain. And that changes the dynamics of the transaction quite a bit from the way it was before. And that's depending on what industry you're in, that could be a big change that could come into, you used to be able to do transactions where you go in and say, well, instead of you doing a stock sale of your S Corp, we'll buy your assets and we'll pay you for your step-up, because it wasn't that much for the benefit the buyer was getting. Well, if all of a sudden you put things over and that's ordinary income on a much larger amount of things that are being sold, that can make a big difference in the economics of the transaction, on whether a buyer can pay for it or what it makes sense for the seller to do.
Yeah, I was going to bring that one up later. That to me is probably the biggest change. It got like no publicity whatsoever, because you think of all the big tech companies out there, it's patents, inventions. I mean, what does that mean? But it's self-created assets. So that's what you got to understand. So it's things that you've developed on your own. It was originally applied to literary works, copyrights, that sort of thing. You make music, you sell it, it's ordinary income. sort of some things like that. But now, you think, what is Microsoft? I mean, patents, inventions, so you have to self-created, you buy it, and then you make all these changes to it. What did you buy and what did you self-create? I mean, it's been a long time sorting that out, but it's a huge, you think where's most of the value created in today's businesses? It's a lot of it's technology. And so when you're talking about ordinary income assets as being sold through processes and formulas and inventions and patents, those terms are so broad that we don't really yet know what they mean. But I can assure you they're going to take the view that, they're as broad as they can. So it's, you pay an ordinary income tax on that to the capital gain, that'll be a big difference for them.
So does that mean when you do a step up or an asset sale, now you have a lot more fights about the purchase price allocation?
Yeah. It's going to be hard to argue that if you buy a tech company. You say, oh, we allocated it to, what else are you going to allocate it to? I mean, how do you distinguish that from goodwill? Now, that's going to be the challenge. Because it's not, I didn't say goodwill was no longer a capital asset. Right. It said self-created patents and inventions. So it said, oh, it's not the patent, it's the goodwill. Good luck with that. So it's,
and then where do customer lists fall into that?
Well, they haven't attacked customer lists yet, but unless it's considered to be know-how or something.
yeah. They have a lot of very vague terms in this statute that just aren't defined. That'll be a big issue for a lot of tech.
And what other issues are out there? Very much as this patent issue did not get a lot of press. I certainly wasn't aware of it before I started to prepare for this. I'm sure there was a CLE I slept through that may have sooner prepared me. But what are some of the other pitfalls and traps that aren't getting a lot of play, but are going to have a significant effect on people's acquisitions, dispositions, and just running their businesses?
Well, one of the things that people, when we talked a little bit about the interest limitation, well, if your interest is limited, and maybe not so much now, but even maybe now, based on that 30% limitation, then it becomes a carryover. Well, now, similar to net operating losses, that carryover on a change in control can be limited. So there may be a company out there that says, hey, I have, these net operating losses, and also have these interest carryovers, that can be used, or if there's a change in control, someone buys a company, those carryovers may not be worth very much, or as much as what you would think. So there's some new things and some new carryovers that can be affected by purchases that all has to be considered in an acquisition.
To me, part of it goes back to a sort of modeling issue, because what seems to be intuitive maybe is not anymore. And I was reading this article, it was talking about the pass-through limitation. Not get too far of that, but you get a 20% deduction for 20% of business income, but it's subject to a limit. It could be 50% of your W-2 wages, or another limit, 25% of your wages plus 2.5% of your adjusted basis. And so, you're looking at a partnership, you're thinking, okay, I've got all this income, I get a 20% deduction, but if you're assuming you're subject to these limitations, you may not be paying any wages. You may have just a whole bunch of partners out there and not realize that what they get as income, if they're a partner, is not wages. So, if you don't have a lot of capital assets, you think, oh, I get a 20% deduction, and actually your limit is 0. And so this author of this particular article was talking about, well, maybe you should be an S corporation, because in an S corporation you get flow through blood, you can pay wages, and so you have to run the numbers to see if you're better off having wages, so you increase the limit that you can use to take the 20% deduction. So you don't really think through all that, the different structure, whether it's wages or not. You can't really have wages for an owner in a partnership according to the IRS, but you could in an S corporation.
Well, what if you lease your employees?
Yeah.
Does that make a difference? I mean, we don't know yet.
Well, that's W-2 wages, you do know. That's not W-2 wages. So,
so if you lease your employees, and that may make a difference. We have other ones that, it's not part of the consolidated group, but maybe you have a family organization where you have one entity that has most of the wages, and the other one get a management fee. Well, if you have the employees in the wrong place, that can limit you on getting the full benefit. So there's a lot of stuff out there that may ultimately get, with some technical corrections, that it may get fixed a little bit. But right now, there's a lot of uncertainty.
So let's step back a minute to our beginning conversation on LLCs versus C Corps. And let's talk about acquisition vehicles. A financial sponsor, a family office, a private equity fund is interested in acquiring a company. They've done the diligence, they've looked at how the new tax code is going to treat the various assets. What should you think about when structuring your fund? Obviously, the choice of entity is a significant choice, and we briefly alluded to some of the rules on leverage and what debt you can bring in, but how does the tax code affect what entity you use and how you finance it in setting up an acquisition?
Well, I think we've gone through that. You really sort of have to think about your exit strategy. Your kind of income are you generating? What do you think that's going to do? I mean, there are people I'm hearing that say we want to be a subchapter C corporation because we think we're going to accumulate that income for some significant period of time at 21%. Well, I mean, there are some other rules out there that are designed to prevent you from doing that in a smaller context. You have the accumulated earnings tax. If you accumulate income, you have a reasonable business purpose for it. You can be subject to a 20% tax at the corporate level. If you have a personal holding company, if it's, you got to have a relatively smaller ownership size, and you have to have a lot of passive income. But if you start using C corps just to accumulate income and you don't have any real business purpose, there can be some gotchas there that come back and say, that's good, but there are code provisions out there who are designed to force you to pay out that money and pay 2 levels of tax on it if you don't have business purpose or if you're not using it in the context of a business.
Another thing that we're not sure how it's going to end up going, but before the corporate tax being 35% and individual tax being 39.6, we're close enough that most of the time lenders, from the standpoint, they say, well, you either pay tax at the corporate level or you pay tax at the individual level. It's just tax, it's just where you're paying it, right? And so there wasn't much pushback as it relates to making distributions for taxes, because if I don't make a distribution for tax at a partnership level, I'm going to pay tax at the corporate level, and they're pretty much the same. But now all of a sudden, the tax rate for corporations is 21%, versus with the 20% reduction, the net effective tax in individual is 30%, so you have a pretty large delta of 9% there. So from a lender standpoint, you say, well, why would I want you to, make a distribution to all your partners of a higher amount of cash? Because you could be a corporation and we'd keep more cash in the corporation, and I'd be better off as a lender than I would otherwise. So I think we're going to get more pushback from lenders saying, how much are you really going to be paying out to your partner, because it's for your benefit, not for my benefit as a lender. So that's another consideration.
And a similar issue to that, even if it's not a C corporation versus pass-through, if you have a pass-through, you have a provision that says that it requires tax distribution. What's the amount of that distribution? Because normally it'll say something relatively simple, maximum marginal federal tax rate. You live in New York City or something, if you really want to get a lot of money out. But if you're the money guy and you want the money to come to you and you don't want it to go out to the people for a tax distribution, you may want to say, no, wait a minute, maybe we qualify for the 20% pass-through. That's a deduction, that's not a rate. So if you just, if your documents just refer to a rate, you're going to be a higher rate. If you want it to be a lower rate because these people are going to get a benefit of that deduction, you're going to have to redraft that provision so that it's taking into account, the deduction under that particular section. So, there's a lot of sort of weird things that can happen on that one. Another issue, just because I know we got a lot of family office people here, they eliminated the miscellaneous itemized deduction, which included expenses incurred for producing investment income. I think, well, most family offices that they were deducting those expenses under 212, subject to the 2% limit. Now it's just gone altogether. There was a recent case, however, that a little ray of sunshine on that, and the lender management you know, Linder's Bagel. They had a bunch of different family offices, all with the same family, but they had one management company that was doing the sort of family office services for all of them. And what they did, they set it up so that the fee paid to that management company was basically a carried interest. It was not a deductible payment. It was a sharing of profits. So it didn't show up as what otherwise would have been an investment expense deduction. And so they were able to get it out of the family offices into the management company. And the IRS took the position, well, the management company was still an investment vehicle because it wasn't engaged in a trade or business. And they said, well, no, it is, because it's doing it for 3 or 4 different family offices that have multiple employees. And so they were able to get around that. They weren't doing that. I don't think they did it. It couldn't have been that far in advance because this case has been litigated before the statute. But there are things to look at in the family office about how you can get those fees out to a service provider without being subject to these limitations. That doesn't mean the IRS is going to like it, but there are some things to look at in that. They were trying to just get rid of that. So, whether they're successful, there are going to be some planning strategies to avoid that as well.
So, with all that in mind, what are the biggest current uncertainties under the tax code, and how long do you think before some of these things get resolved? I'm sure there are some things that will be resolved shortly, and some that may take more time to work through the system. What are the biggest question marks relevant to deal making that you have in your mind? Rick?
I think it's just understanding all of this, understanding it coming in and going out and all the different permutations, whether it's the expensing of capital expenditures up front, and if you're a seller, you may say, golly, if I can structure an asset sale, whether you're a buyer and you say, when I'm thinking about my tax, my cash flow in terms of paying taxes, well, if I can pay a whole lot of taxes between my interest deduction and between CapEx, if I'm buying a capital intensive business. So I think it's just going to, people don't know what they don't know right now. And I think that people are going to have to work through all that math to figure out how it really affects deals. And I suspect that it'll be deal making as normal. And people will sort of say, I'm just going to go forward on the stuff and not worry too much. Because I think if you worry too much, you could also have paralysis of trying to think through all the different permutations on this stuff. Because, as I said, it affects you both coming and going. And I think it's going to take quite a while, especially for the private equity community, to sort it out. Because ultimately, they have to be in the business of doing things, and they can't really wait around to figure out the perfect structures.
I think on the technical side, the biggest uncertainty is, or we talked about, if you buy assets, you can deduct fixed assets. You can take bonus depreciation 100%, and which is a very big benefit to the buyer. But if you were to, instead of buying the assets directly, if you were to buy a partnership interest, where you would otherwise get a step up of those assets to the partnership interest, it's very unclear now whether you can take that bonus depreciation. And so transactions, if you're not focused on that, you may put in, it may get fixed the right way, it may get fixed the wrong way. Different firms are taking different positions right now, but it's only based on what they think is going to happen. They don't know exactly what's going to happen. So unless you know some of these areas that could be kind of a gotcha out there, that, because you can potentially structure your transaction a little differently so that you, even if you are not purchasing 100% of the assets, that you're not purchasing the partnership interest in an acquisition to avoid that. So that's one of the greatest areas right now. And I can tell you that if you were to ask, 4 different firms, you'd probably end up with 5 different answers.
My biggest question is entertainment expenses. That's the one I have a problem with. So you read the statute, and I promise you, if you look at half the articles out there, they talk about meals and entertainment, meals, food and beverage. Is that deductible? 50%. Half of them will say, yeah, 50% is still deductible for food and beverage. The others say, no, none of it's deductible. I sort of took a poll of the accounting firms. They will all tell you that it's not deductible. But the real issue there is that the way they changed the statute is so poorly drafted. You actually, I challenge you, if you read it, you can't tell exactly what they did. It used to be pretty clear because they said they used the words food and beverage. You only get a 50% deduction for that. They took that out. Now it just says entertainment expenses. Right, so if I go to lunch with Latcher, is that entertainment? I think not. Is
that for pain and suffering?
It's a serious point. You're with a client. We have a meeting. You know, we're working on a deal, and we order lunch in with a sandwich. Is that? It's food and beverage, but I don't know that that's entertainment. So there was kind of an issue. How are they going to define what is an entertainment expense for purpose of this statute? Let me tell you, there's a, you know, you think of the entertainment industry, what is the impact on that for you? Why do they pick on those people? You know, they already hit them at 50%, and now it's nothing. You got restaurants and all that. So, but you have people out there who are trying to figure out their golden life and how to deduct their next meal. So that's not good.
So what's going to happen to all the sort of the corporate junkets when you take clients? We had a client call us the other day and said, I'd sure like to go to Augusta. And you know, they're a good client. I don't know how much it's going to cost us to get that client there. But what happens to all of that? What happens to, let's say, the steakhouses whose business is built on that?
Yeah, it's all non-deductible unless you claim it's not entertainment. You know? That's hard to do when you're going to it in an event or something like that. I think that the interesting one is sort of the business meal versus entertainment question. You know, which one of those are which? And I don't know if there's a lot of business meals, but you know, they just pass stuff like that and they mark it up in a day and a half. Now, you know, they say that, but you know, look, if you ever look, I wouldn't suggest it, but if you look at the rules on that, the pass-through, the 20% pass-through issue, I mean, it's about as complicated as it gets. It's like somebody spent like 2 years coming up with that idea just to throw it out there at the last minute. And they go, yeah, let's do that. It's immensely complicated. And let me just tell you, the international stuff, which we hadn't talked about, was probably, I mean, the 21% corporate rate is a big one, but there's more money in the international side than probably any of the rest of it, and it is extraordinarily complicated.
Well, thank you, gentlemen, very much. I think we've learned a lot from the panel. I've got one final question, and then we will open for each of you, and then we will open it up to any audience questions. And that's this: in one sentence, without semicolons, hyphens, or parentheticals, what is the most direct advice you would give a client on the new tax law, other than see a professional and make sure you understand and talk it through with them?
Don't believe what you hear at cocktail parties.
Modeling is a lot more important than it used to be.
Ignore it, go do the deal anyway. Thank you. That's how I get paid.
Questions? Are there any questions from the audience that you would like to ask our panelists?
Yes. Great panel there, I tell you. But we have a question on the international direction that we're speaking of. I know we're speaking nationally from the things that's in place and abolishing that need to be done. But as we speak on the international side, there's still an island of a kitchen type of, we don't know yet, or we need to wait and see what's going to happen.
No, there are specific rules out there that they're just so complicated that we thought in this type of a form that, and some people would not have international operations, that wouldn't be the best thing to go into it. But there are, to a certain extent, an aspect of the international has been simplified as far as the way things are being taxed, but then it's become more complicated because it's not as straightforward, you know, as far as the way that the U.S. put in place. So we took a system, we took a territorial system, which a lot of other countries use, and we made it like 10 times more complicated.
Well, yeah, not to get too far in that, but most countries have a territorial system, so if you earn income there, you pay tax there. And so when they came out and said, oh, the U.S. adopted the territorial system, not even close. I mean, it's a hybrid system that took, like, depending on the point of view, the best and worst of both of those and try to put them together. So it's territorial for some part and it's worldwide for others. And you got to put those two together. So it's, I would say modeling is like 10 times more important on the international side because there's so many different provisions that you have to look at all at once. If you move one piece, it's going to move somewhere else.
So the key point is model.
Yeah, it's, I agree with that.
But I think one thing you're going to find is that what has happened over the years in the M&A market is we've gotten to the point where process, a banker in the right situation sort of drive process and drive people through diligence a lot quicker. So I think if you have a situation like that, you know, these are details that, you know, that the banker and its client is going to try to convince the other side, don't worry about it. You know, if you want the deal, you can worry about this later. Obviously, a one-off negotiation or something where maybe you don't have leverage, all those things come into play. But we have just seen a dramatic increase over the last 10 years of sort of the seller having power in the diligence and in the contract. Eventually that will reverse, but I think until it does, here again, I think some of these nuances in the right auction setting for at least sale of the business probably will be pushed aside and suggested to be not material or cause someone to lose a deal.
Any other questions?
Steve, you asked earlier, you said earlier in the conversation, or at the beginning of the conversation, there was a $500,000 loss limitation.
Yeah.
Is that by entity, or is that by investor, or?
Individual taxpayer, that's for a joint return.
Okay.
Yeah, that's at the individual level.
And is that passive or reactive? It doesn't matter?
No, doesn't matter.
That's per year.
Yes. But it's, you know, that's people with a lot of other income. That's you get to aggregate all your trading business income. So you have 3 different trades or business, one against the other, but it's your other income. So if you have dividends, interest, whatever other kinds of income that's not connected with the trade or business, you can only offset that to $500,000.
So across all your investments. So if you have 10 companies losing money and they lose, you know, $100,000 a year, you're only going to deduct the 500 of that $1 million.
Right.
Okay.
One question. So we've done some modeling around this stuff, and one of the things that comes up in modeling is also, hey, we still need to figure out a bunch of answers or do our questions, especially around the business deduction, 20%, the passive business deduction. Sorry. Everyone says, hey, there's more to come. There's more to come. We're not sure. We're not sure. Do we have an idea of when more stuff is coming? Like, is it a month from now, or is it towards the end of the year? Because that really does impact how you structure stuff that you're going to do within the current year. And so that's where we're struggling a little bit. It's like, okay, when do we get more guidance? How do we structure it and stuff? So,
You know, if you look at prior to the '86 Tax Act and technical corrections that came out of that, there were certain things that came out not too far after if they knew it was messed up. But most of it comes out after taxpayers have done things that they, you know, Congress thinks was not intended. The IRS thinks, you know, wasn't intended. So you'll probably see technical corrections happening for the next multiple years.
Yeah, but you know, regulations to come out to explain it. I mean, it'd be a miracle if it was 6 months to see. There'll be like notices and stuff like that, like they just did with the S Corp. The things on technical corrections, it's just a political football right now because the Democrats are saying, no, you screwed it up. We're not going to help you fix it. We want you to look bad in the midterm elections and say, look what they did to the tax code and they can't even do it right. And so, you know, there's one out there, I don't remember exactly, we all decided we weren't going to read the provisions on cooperatives because we don't have any agricultural funds, but there's one of them that says basically they can sell products at tax-free if you're a certain kind of cooperative, and now everybody else who sells the same products that aren't in cooperatives are getting, you know, priced out of the market. So they said, okay, we're going to fix that one. And then whoever's got that stuck in there said, no, we meant that. We want that wasn't anything. So I don't know if they're going to fix that one, but that was sort of one of the bigger things.
So you're saying we can be creative and we can depend on you for legal advice, right?
Yeah, that's it. Yeah.
Yeah, one question. Some of us have clients in other states. Is there much reality in this ability for states to have their people, make contributions into this tax-free charity kind of deal to get that reduction?
Personally, I think it's a joke. But, they're states that have already passed those kind of laws. If you're not familiar with it, they say, okay, they took away the property tax. So the state's going to set up this charity. It says you donate to the charity and you get a credit for that charitable deduction against your property tax, or however they're going to structure it. Well, I mean, the definition of a charitable contribution is you give something away and don't get anything back. If you get a credit, it's hard to see the charitable contribution. So I just think they're sort of tilted the windows personally, but they're doing it. They're doing it.
Sir.
Are there any factors that change in the Texas franchise tax for all these changes in federal tax?
They haven't met. So there was an interesting article about that, not Texas, because I don't know what they're doing in terms of, any, Jason, he might can tell us. I haven't even heard it, and so I'm going to get involved in some of the stuff in Texas, that they even have anybody, looking at it. But there are a lot of states that are saying, look, they used to just mirror the federal and just take a percentage. They say, we're not doing that anymore. We're not going to allow this pass-through deduction. We're going to do these other things. So I think a lot of states are looking at sort of delinking from the federal tax code, which will make everybody's life miserable. The county's life. Every state's return will be wildly different.
I think we are now at 7:43. Unless there are any more questions, I believe the bar is still open. Seeing no hands raising, I want to thank everyone for your time.